Welcome back to Everyday Economics, the podcast that helps you learn about the economic world happening around you every day. I'm your host, Chris Krug, president of the 501c3 nonprofit, nonpartisan Franklin News Foundation. Everyday Economics is a production of America's Talking Network. You can listen to all of our podcasts at americastalking.com. To support Everyday Economics and podcasts such as this one, please make your tax-deductible charitable contribution by clicking the link in the show description. We're recording this episode on Friday, September 29, 2023. And joining me, as always, my friend, the great Dr. Orphe Divounguy, PhD economist. Hey, Dr. O, you took some insights into the market, in your role as an economist at Zillow. And it seems like it's getting a lot of traction. Business Insider's picked it up. I think Yahoo's picked it up. I'm sure there's many other outlets that have picked it up. You're looking ahead at the next 12 months, so really the next year, out until the end of August or perhaps the beginning of September of 2024, and you're forecasting, and I'm not put words in your mouth, you can tell me what, the strength of this forecast, that home prices you think are going to see another 5% increase. You feel like mortgage rates are going to level off and hang in there. And the housing market itself is going to stay in this, not necessarily a state of like a stasis that we're in right now, but it's certainly not moving at the rate that it was moving a year ago at this time. Or really, I don't know when was it really going crazy? Maybe the spring of 2022. 15 people bidding on everything.
That's
and
2021. We had the craziest surge in housing demand in a long time. No, I mean, look.
So to summarize, you think housing prices are going to go up. You think mortgage rates are going to largely stay the same.
No,
yes?
No, not quite. Let's just put it this way. I think that
I oversimplified you, my friend.
I think here's the thing. I think mortgage rates are probably going to go up a little bit more, and that has to do with the fact that yields are increasing, right? So you see, real yields are increasing. You have expected higher fiscal deficits in fiscal year 24, 25, 26. The yield on the 10-year is likely to go up by about 25 basis points for every 1 percentage point increase, 100 basis points increase in fiscal deficits as a share of GDP. And so, of course, I see nominal yields, I see real yields increasing, and the mortgage rates tend to follow the yield on the 10-year. And so I don't see why mortgage rates will fall at this point. I think mortgage rates are likely to continue to tick a little bit higher. They're probably going to settle somewhere in the range of 7.5 and 8%, maybe around closer to 8%. Who knows? But there are massive headwinds. And the headwinds, of course, are rising oil prices, tighter credit conditions that are going to slow down the labor market, right? All these things are likely to actually, kind of cool down the U.S. economy, right? And that could actually maybe put a roof, put a ceiling on yields and mortgage rates. Now, why is the housing market slowing down right now? The housing market is slowing down for two reasons. The first one is it's normal for housing to slow down, housing demand to slow down in the fall and early winter, right? So typically every year, people move in the spring. And late summer, early fall, up to December, the housing market tends to cool down. So that's absolutely normal. The fact that mortgage rates are higher is adding additional pressure to cool down, to moderate the pace of housing activity. And that is why we're seeing August sales decline somewhat, right? It's been another shock. Mortgage rates have increased a little bit more. On top of the normal seasonal cool down. And that is why we're seeing sales decline. Now, you also have to remember that part of this story is the fact that mortgage rates actually have a larger negative impact on supply than on demand. I think that's the part that everybody's so surprised about.
Let's get into that, because I think that's an important part of the findings that you're bringing to the market that are kind of underpinning your insights here. That there's not a profound volume problem just yet, but but there's definitely a volume problem with regard to available homes. You and I have talked oodles and oodles of times on here about like there just not being enough houses in the marketplace, and I think that's a pretty solid foundation for you to stand on, and I don't think it's nobody's going to argue about that with you, right?
Absolutely. We're short about almost a million existing homes when compared to 2019.
So help me to understand this. There's a couple data points inside of your work that's been now reported elsewhere, and I want to try to pull it back to the source since you're the source, right? I'm pulling this from Business Insider, which not necessarily my favorite source for information, right? But it says this. It says inventory levels, though, have increased slightly, which was cited as the reason why Zillow chose to downgrade its home price forecast. New listings jumped 4% last month, which could help ease supply pressure and cap home prices over the next year, right? Then there's a quote in here from you, but it goes on to say, experts have warned housing affordability is unlikely to improve until mortgage rates dial back more significantly. That could unlock more inventory to hit the housing market, but it is unlikely to happen anytime soon, with experts forecasting mortgage rates to end the year around 6%. Well, 6% is a far cry away from where we are now.
I disagree with the experts that they went out and got. I think mortgage rates are going to remain above the 7% mark, maybe even above 7.5%. Which takes us back about, this is like 25 years ago. I mean, this is honestly, this market from a pricing standpoint or from a mortgage pricing standpoint is very much in line with when I bought my first house in 1998. That it looks exactly
a lot like,
a time where growth was robust, and so yields were really high. Absolutely. So, but let's go back to that story. I think one thing that people forget, is everybody's always worried about price crashes in the housing market. The reality is Zillow research shows 80% of homeowners with a mortgage have a mortgage rate below 5%. And that means there's people with 4% mortgages out there, 3% mortgages. My neighbor's like 2.7, 2.8%, something like that. He has no incentive to go out in the market today to list his home, to sell it, and to go and get himself a 7.3% mortgage rate. No incentive whatsoever. That's thousands of dollars more in terms of monthly payments, right? Especially given that house prices are way higher than they were when he bought his house. Okay. So he has no incentive to do that. Okay. And so, when you look at new listings are still down. They've been falling since 2018. People are just not selling. They're just not selling. And so when you look at the existing homes inventory today, it's almost 40% below what it was in 2019. And that amounts to about 900,000, a little over 900,000 homes. And so, if you don't have a lot of inventory on the market and you still have demand where it's at, you basically have a supply constrained market and you just can't get a big price decline. You just can't. Now, of course, I'm not saying prices are going to be soaring. They're not, because builders have been building. That's the good news. Builders have been building. And when demand still exceeds supply, builders have an incentive to build, and builders have been building. Housing starts have picked up again in 2023. Yes, they come down a little bit last month, but there's a lot of units under construction right now. 1.8, I have roughly 1.9 million units between starts and permits that are coming, right? And plus the units that are already under construction. And so builders have been active, as of late. Of course, builder confidence waning somewhat because they're seeing demand slow down a little bit, which is somewhat normal for this time of the year. Yes, mortgage rates are playing a role on demand as well. But when it comes to prices, ultimately, you can't engineer a price crash unless you have a ton of new units that come at a time where demand is slowing. And we just don't have that. We're still short. We're still short from where we were before the pandemic. So you still have a supply-constrained housing market. And now, of course, that means there's a floor in prices. Prices are not going to tumble.
Well, I appreciate the insights as always. For Dr. Orphe Divounguy, this has been Chris Krug. Subscribe to Everyday Economics and dozens of other quality podcasts at americastalking.com.